Another fun-filled mortgage and finance news week. This week, major topic being Fed minutes number one and two, jobs. First, let's talk about the Fed minutes. Now, the Fed has really stayed consistent with their talk that they are going to be hell-bent in pushing for this 2% inflation number. And in order to do that, they are more than suggesting at this point that there's going to be another Fed funds interest rate increase in the July meeting. Now, we made an important distinction last time when we spoke about this, when we told people that the decision to not increase in June was actually a skip and not a pause. This is further evidence of that. A pause would have meant that they're stopping and kind of reevaluating, where a skip meant, hey, we're going to just skip this meeting, but our plan is to go back to what we had projected all along. Now, the reason that we're seeing really big movement in the mortgage rates this week has to do with jobs. So we had the ADP report come out this week, which shattered expectations, whereas we had initially projected around 240 new jobs created, and we more than doubled that at just under 500,000 new jobs. And again, this is something that the Fed is really clinging to and pointing to as the reason that the economy is so stable and that they need to be so aggressive in the fight against inflation. Now, we also had the BLS jobs report, which came in significantly lower. Now, this is typically reversed, whereas BLS comes in a lot higher than ADP. So this might be somewhat of an anomaly. And if you look at the majority of jobs created, they are part-time and in the leisure and hospitality space. Now, we know that leisure and hospitality really got impacted and affected over COVID and during the pandemic, when we saw those jobs literally slash down to next to nothing in 2020. And it's certainly been the biggest sector of job growth ever since. Now, leisure and hospitality is currently showing more jobs than even before 2019. That being the case, that pretty much tells me that that might be a sector that's pretty much maxed out in their ability to grow any further. Moving on to a different topic now, I have been approached by multiple people recently that are talking about how they really want to eliminate their mortgage debt. And while I agree with that principle, I'll give you a few examples of why sometimes I don't think that makes a ton of sense. So, I had one client that I met with this week, and he had done a really good job of saving and acquiring real estate over the years. Now he's self-employed, so his income is less than consistent. Let's say he does not have a 401k and has really minimal savings. What he does have is 4 rental properties, all paid free and clear. That's amazing, and his portfolio of real estate is probably over, let's say, 1.5 million in true equity. One of the things we discussed with him was if he, was open to it, we could acquire some debt on one of those rentals, debt by the way of a mortgage. And what this would do for him is, one, give him some financial security in the event of savings, in the event of, investing in another area and diversifying, right? Because let's just say when you have 4 homes, all tenant occupied, something's bound to go wrong. You're going to have usual maintenance and repair. And let's just say something, a big expense did come up. Well, his option to pay for that, since he's minimal in savings, would have been borrowing that money by way of unsecured debt or credit card debt. And unfortunately, we know that with the Fed funds rate as high as it is, interest rates now on credit cards are approaching 27, 29. I've even seen over 30%. Again, that's compounding interest, which is just really going to escalate, rather quickly. With a mortgage debt, we know a few things, right? Number one, that's a fully amortized payment, and the interest is tax deductible. So you're already getting a significant gain there. Now, the mortgage debt that you take, right, is leveraged in that you're not paying any income on that debt. So he could take $250,000 gain in an actual asset and not pay any tax on that amount, right? And what that would allow him then to do is acquire maybe another asset with it, diversify in terms of other investment opportunities, gain some financial security. And again, his hesitation being, well, I don't want to utilize the equity that I've gained. Well, I posed this question to him. On your $400,000 valued house, by having a $200,000 loan, does that diminish the value of the home? And the answer is, of course not, right? The home is worth $400,000 without a loan, and it's still worth $400,000 with a loan. And will that home appreciate more or less with you having a mortgage on it? And again, the easy answer is it's going to appreciate at the same level. So really, you're not devaluing any of your assets by having a mortgage loan. What you're really doing is giving yourself an extra element of financial security, right? And adding to your opportunity to invest. In summary, what we were able to do for this client is show him a creative solution that met his financial goals. And sometimes, right, it takes a look outside of the box to determine what might be best suitable for somebody. And again, having the experience and having the knowledge to find these solutions is really what makes a good loan officer in today's market. While most people are focused just on the interest rate and just on the payment, I think analyzing the entire financial picture is really the key to set someone up for financial success. We look forward to next week and more financial news coming your way.